Any questions? Please just confirm you can hear me. Even if you don't have questions, just say yes. Okay.
Yeah, please. I have a question.
All right.
Yeah, just one word or two. When you were talking about the oligopoly, you said Nash equilibrium and one other thing. So is the other one I want to
Kinked model.
Gates model? Okay.
Yes. There are others, or there's Stackelberg model. So you have to go and read that. But I just called out those two.
Okay. Thank you.
Yeah. So they are basically four. So I've mentioned three. You can get the last one. Okay. All right. So one online, one physical. So I'm good to go. All right. So we mentioned two things: fiscal policy and monetary policy. So what are the things? We now ask questions. So we mentioned that in fiscal policy affects individuals, right? It also affects government as well. So it affects both of us. We mentioned that it affects money supply. I mentioned that it affects inflation indirectly. So we move to money supply. So, of course, monetary policy is solely the responsibility of the CBN. They decide how much they want to push in the economy and how much they want to take out from the economy. I ask a question: if they decide to take out money from the economy, what kind of policy is it? Is it expansionary policy or recessionary policy? This should be Chorus answer now, guys. Any answer?
Contraction.
Exactly. Thank you. Is that on here?
Yes, but sorry, you said
All right.
it be expansionary or recessionary. I think that's what confused some of us.
Oh, so recessionary also means contractionary. They are used interchangeably. So you can hear recession or you hear contraction. Okay, so yes, you are correct. So the moment CBN is taking money out of the economy, it means they want to contract the economy. They want to contract the economy. They want to restrict the economy. So that also links to inflation. If they are taking money out of the economy, it means they want inflation to what? Come down. So as Nigeria is now, that our inflation is high, the normal monetary policy we should do is to take money out of the economy. But Nigeria is not really a good example because we are faced with different other factors. We still have exchange rates that will battle there. We have inflation. We have the fact that we're not producing enough locally. We have imports. We'll talk about all those things, international trade and all. So there are different areas, but in an ideal economy, one of the ways you fix inflation is by bringing down money supply. Okay? So we'll talk more in details about that. So that's what we are looking at in this monetary policy. Then we look at the ways in which CBN decides to do this. So everything I've told you is around contractionary or expansionary. Everything I've told you is around those two things. So you should find a way to link it to inflation, money supply, and then we'll talk about interest rate as well. And then private consumption and investment. What does that mean? In a recessionary situation where we are in Nigeria now, are people spending money anyhow? No. Because first of all, you don't even have the money. You don't have the money, so you have to find a way to manage the money you have. But of course, Nigeria is a different situation because we are in recession and our inflation is going up.
Exactly.
Those two things are not so exactly. So
Like I've been
just
asking like around it. That's why I had to call you back to that contractionary and recessionary. Like I'm trying to literally explain recession. And I'm using Nigeria as a case study. It's not tying up. I mean, we are not, this economic policy is not working in our country. Because how do
that's
we
why
recession
that's why
and
Nigeria problem is big. You cannot just bring one man and say one man should fix Nigeria. We are so behind that we need a lot of things to work together for us to even be close to meeting better what other countries are doing. So this situation is a typical situation, which is why it doesn't make sense. You cannot understand it because Nigeria does not follow normal economic policies and normal laws. Because, like I said, we are reading it in theory here. There's an assumption here that all other things are equal and not changing. But Nigeria does not work that way. Nigeria especially. So bringing one policy can be a good idea to fix the problem, but it can give a wrong result because of another issue that is happening. Remember the lags we spoke about: recognition, action, and the last one. So recognition, first of all, you need to recognize all the problems in Nigeria before you provide a solution. If you only recognize one problem, you will only be fixing one problem. But at the end of the day, the impact may not be what it is that you want it to be. So that's where Nigeria is different. We have recession. In an ideal recession, there shouldn't be inflation. Because if you are in recession, you should not even have money to spend. You should have small money in circulation. And because of that, prices of things will automatically drop. Because the people that are selling to you, they have to make money. So what would they do? They try and sell for as low as possible so at least they can get markets. But because there is an import and export side to it, we are now affected by exchange rates. We are now affected by fuel subsidy removal. Fuel subsidy removal links to transport costs. And 90%, if not almost everything you are buying, except for services, you have to transport it. It has to move from point A to point B. It will not disappear. So the fact that it's moving from point A to point B, even if the cost of the product is small, by the time you add the transportation cost, which is high now because of fuel subsidy and the rest, something that is supposed to cost 5 naira now starts costing 15 naira or 20 naira, which brings the inflation up. So at the end of the day, the product itself may not be going up, but because of the transportation cost on top of it, the product is going up. So that's where you have that dynamics with Nigeria. It's a weird dynamics. So you get the point now, yeah?
yes I do. Thank you.
Yeah. All right. So we are abroad now. We're writing CFA. We're not in Nigeria. So we are thinking internationally. We're not thinking locally. So let's go back to international thinking, UK thinking, or US thinking, anyone you want, or Canada thinking, anyone you want. So, like I said, everything we are going to talk about here, you need to be able to link it to expansionary or contractionary. Very, very important. Okay. So roles of central bank, I'm not going to waste my time on this. Sole supplier of currency, banker to other governments, regulator and supervisor of payments, lender of last resort, conductor of monetary policy. So this is the one that is important. Central bank controls or influences the quantity of money supplied in an economy and the growth of money supply over time. So how do they control this? Money comes from commercial banks, right? Commercial banks have a relationship with with central banks. So CBN can say, I will bring a policy whereby commercial banks keep more money with us. What does that mean? It means the money commercial banks can give us as individuals now becomes limited. And it goes the other way. CBN can bring up a policy to say, okay, I want commercial banks to have more money. It means commercial banks can give us more money. That's the relationship we have there, basically. Also, we look at interest rates. We'll talk about that. when we go further as well. Because interest is also linked to this. If you remember, there was a time we could go to the ATM and withdraw as much as we wanted. 50K, I think we could withdraw 50K at some point and things like that. But at some point, they started restricting cash withdrawals. They started restricting cash withdrawals, off-the-counter withdrawals, all those things. What are they trying to do? One, they were trying to reduce cash itself and increase other forms of payments, internet banking, POS, and the rest. That's one way. Another thing was they were trying to reduce money supply. If you know, when cash was scarce, most people reduced their purchasing power, because especially at that time where we had issues with delay in POSs, internet banking was very slow. You need to you ask yourself that this small cash I have, this 1,000 naira I have, I cannot use it to buy anything anyhow. So automatically your spending is reducing. So the money supply started reducing. You see people saying, "Oh boy, I've been holding this 1,000 for 2 weeks now. I've just been doing transfer up and down because I don't know when next I'll see money again." So people kind of adjusted their spending and things like that because of the situation. Okay. Now, the key thing to note is the primary objective of a central bank is to control inflation. Is to do what? Is to control inflation, so as to promote price stability. So you see why at the end of the day, people are always saying, "Oh, CBN, inflation is going up, it's your fault." CBN governor, Cardoso and the rest will come out and say, this is the situation. This is what we are going to do. This one we believe will help us reduce inflation, because it is his responsibility. It is CBN's responsibility to control inflation. And they can control inflation using the money supply. Remember the relationship we said, positive relationship. You want increased money supply. You want increased inflation, then you have to increase money supply. So they had that control within the organization, within the country. Apologies. If I say I want to reduce inflation, what kind of economic policy would I bring? Okay, think about it. Keep thinking about it. We'll come back to it. Don't worry. We'll get to the stage where you answer the question. All right. So that's basically so the main purpose of CBN is that inflation. Then you have other goals: stability in exchange rate with foreign currency, which is this one we are experiencing now. As at 2 days ago, I haven't checked as at yesterday, but as at 2 days ago, FX was at 1.4, and black market was at 1.4 as well, or 1.15, I think. So we are getting to a stage where CBN rate and black market rate are almost becoming the same, which is what Cardoso is trying to do. So CBN governor is trying to do that so that he will bring more money into the normal channels. He wants to find a way to remove all these BDCs. That is what we're trying. That's what CBN is trying to do. Let's hope that it works, but it will take a lot more pain before we get to where we want to get to. That's almost the story of almost every problem in Nigeria. You can't just come and fix it like this. Things have to be, there's a process. Like I said, we've gone far down that we need to make some strategic, more like the resets, like a full reset, before we can start going in the right direction. Okay? All right. So the next one is the tools for implementing monetary policy. So any other question or I continue? All right, moving on. So the monetary policy tools One of them is policy rates. So what does that mean? So this rate is basically rate at which CBN buys securities or sells securities to banks. There's no need for all the plenty English. Don't worry about it. What does that mean? Let me assume that I am CBN. And it is a commercial bank. Can you hear me?
Yes, you can.
Okay. Now, and then everybody, let's say Tayo. Tayo is one of the individuals in the country. So you have me, CBN, to commercial bank, to individuals. That's the channel now. That's how money flows. Now, me, CBN, I say, okay, I want Tayo, who is the individual, to get, let me see if I can, okay. I want Tayo, who is the individual, to get a lot of money. So what do? I will give a policy whereby me, I will give Bolaji a lot of money. Remember, Bolaji is commercial bank. So this policy rate is saying, okay, since I want Tayo to have a lot of money, and Tayo cannot get that money through me, Tayo can only get that money through Bolaji. So what do? I'll say, okay, this policy rate, which is the rate at which I buy from commercial banks, or I sell to commercial banks. I'll say, okay, I want to reduce this rate. So the rate at which Bolaji is going to buy from me, let's say it's currently 10%. And I want more money to be in circulation. So I will drop this from 10% to 5%. So I'm only charging Bolaji 5%. Let's call it interest rate just for this explanation. I will only charge him 5% compared to when I was charging him 10%. What does that mean? It means now Bolaji has more money because of this policy I've done. So the thought process is that as I have done that for Bolaji will cascade that money to Temitayo. Thereby, my policy has worked. Do you understand that? Is that clear? Hello? Okay. So that is the ideal situation. But we know there's a possibility that I will give Bolaji this reduction in interest. And Bolaji will not give Temitayo. Bolaji will say, oh, why am I giving Temitayo money, sef? If I give Temitayo money, how much am I going to get as benefits? You know what I'm going to do? I'll carry that money and go and put it in an interest generating asset. And that's what happens in Nigeria. That's what happens in Nigeria. Because you get a situation where CBN will bring up a policy, and for whatever reason, CBN will bring up a policy to put money in the economy. We as individuals will go to bank that, okay, oh, give me loan. And then bank will charge you interest that will almost cut your neck. Interest that will almost cut your neck. And then you say, I'm not doing again. So that's what happens. You want to achieve, CBN wants to achieve a goal, but it ends up not happening. So that's one of the this thing. But the real one is this policy rate. All you need to know is that when the rate reduces, you have more money. But when the rate increases, you have less money. So you have to link it. Same way I linked it from Chooks to Bolaji to Temitayo. I want Temitayo to have more money, so I reduce my policy rates. That's the exact way you need to look at this example. So where you see reduction, so CFA will ask you, we want to have an expansionary policy. What do I do to the policy rates? You are the one that has to walk back to understand what that means. Okay, Tayo, let's take your question.
Okay, yeah. My question is in relation to what you said earlier about CBN giving money to these guys, to the bank, but bank is refusing, or bank are taking it to something different from what the CBN policy is. Now, the question is, does it mean that CBN does not have a monetary team, or don't they carry out a procedure or a process to see why this money is not used for the intended purpose? For example, the one that happened day before yesterday, right? When I don't know, I can't remember the amount, is it 50 billion or whatever dollars that they said the bank has stacked up over time, but then they were mandated to be released immediately, and suddenly the exchange rates fell, dropped a bit. Now the question is there no monitoring team, or how does that work? Do you know how that works?
So, Nigeria, my country. So it's of course they have teams that monitor these things, but at the end of the day, I have, using our example, I have given Bolaji, the relationship between me and Bolaji is, Bolaji, I've reduced the interest rate for you. I expect you to cascade it to Tayo. Bolaji can come back to me and say, Tayo does not want money. How am I going to prove that? So commercial banks can say, people are not coming to collect money. So what CBN can also try and enforce is try to say, this is the interest rate we want you to charge on this money. So it's not as straightforward as monitoring every bank and then saying, you bank, you did not do this, you bank, you did not do this. In the simplest form, that's what is supposed to happen. But in the complex world that we live in, that's not obtainable. So you have a case of, so for example, CBN says, okay, commercial banks say, CBN will sanction us if we don't do this, if we don't do that. Okay, what do we do? Let's give only 10% of the money they've given us. And they take 90% and they go and put it where they can make money. Remember, it's not a charity. Commercial bank is not a charity organization. They are also here to make money. So they are looking for the best possible money they can, where they can put their money that they will make the highest amount possible. And also at the end of the day, it's this CBN that will still come to these banks and say, your market capitalization is this. You are not up to this. Merge or leave the business. So these banks have to find a way to survive. So it's a bit of dilemma between the two of them. CBN cannot authoritatively tell a bank how to run. That's the truth. They cannot come and say, this is how I want you to run. They can try to advise, give some sanctions and those kind of things, but they cannot fully come and enforce their policy on it. So there is that gap. And then how many banks do we have? And we have only one CBN. How do they monitor all these banks? How do they monitor transactions? So it gets a bit more complex. Do you understand what I'm trying to say? Is that clear, Tayo?
Yeah, that's clear, absolutely. But then I don't know. It's just a Nigeria. It's just a Nigeria issue. It's just a Nigeria issue, actually. Thank you.
No problem. So the next one is reserve requirements. So what does this one mean? This means that there is a percentage of deposits that commercial banks are required to keep with the CBN. So what it says is that commercial banks, for example, let's say 70%. Sorry, 70% is too much. Let's say 40%. What that means is that for all the inflows you get as a commercial bank, you give CBN 40% of those funds, then you make do with the 60%. So what does that mean? if CBN wants to put more money in the economy, they will reduce this reserve requirement. So they'll say, okay, instead of 40%, make it 20%, so that you now have 80% to work with in the economy. And then vice versa. So that's basically what this one is. No need to spend a lot of time here. Then the third one is open market operations. So I'm sure some of you have heard of open market operations. So what this is saying is this is the buying and selling of securities by the central bank. So buying and selling. So I'm central bank. Bolaji is commercial bank. So me, Chooks, I come to Bolaji and say, Bolaji, I want to buy securities from you. When I buy securities from Bolaji, am I paying Bolaji or Bolaji is paying me? When I buy something from Bolaji, am I paying Bolaji or Bolaji is paying me? I need answer, please.
You are paying.
Good. I'm paying Bolaji. So meaning that Bolaji will have more money with him. So you see that everything I'm talking about is linked to how would commercial banks have more money, which we have said is linked to how the individuals will have more money. So if I say, okay, I want to come and buy securities from Bolaji, it means I'm buying, so I will pay money. Bolaji will have cash to do what he wants to do. And it goes the other way. If I decide to sell securities to Bolaji, it means I'm taking Bolaji's money, who is the commercial bank. So if I am taking his money, he would have less money to give to the individuals. Is that clear? So these are the three guys: policy, reserve, and open market operations. This will come up in your exam. So what you need to know is, how can I link this to money supply? That's the only way you can tell yourself, okay, is this an expansionary policy or a recessionary policy? That's the way you can do that. And remember, I said the question will ask you also, this economy is already in recession. You will see a question where it says, this economy is in recession. Oh yeah, you as the CFA expert and analyst, propose a solution for us. What if you are CBN governor? What solution would you propose based on these three things that you have? So it's for you to say, okay, yes, I'm going to reduce reserve requirements, or I'm going to increase reserve requirement to fix this problem in the economy. So you need to have that link. Very, very, very important. Okay? Bolaji, over to you.
Yeah, so I want to ask, so what is the distinguishing difference between the open market operation and the policy rate, since they both deal with securities?
Oh, so the policy rate is just a rate to say, okay, this is the rate at which I'm lending money to you. So this one is more of real lending of money, basically. But this open market operations is more like securities. But they are very similar. They are very similar though. But we are more familiar with the open market operations because you see that one a lot more. If you read the news, you see that a lot more. That's okay. The open market operations now. So CBN is just trying to use that to say, okay, let's use this to move the markets, basically. Okay?
Yeah, thanks.
All right. So the other thing is, so there's what we call monetary transmission mechanism. So let me just take this. This one has a bit of reading in it. The monetary transmission mechanism refers to the ways in which a change in monetary policy, specifically the central bank's policy rates, affects the price level and inflation. A change in policy rates that the monetary authorities control directly is transmitted to prices through 4 channels: short-term rates, asset values, exchange rates, and expectations. So we are looking at this things in details. How does that policy change that the bank has done, how does it apply to this? So if you are familiar, there's something called MPR with the banks. Is anyone familiar with it? No one is familiar with it here.
So did you call MPL or what do you call it?
Yes, MPR. MPR rates.
Yeah, that's the CBN rate. It's set by the CBN, sir.
And what is it? Okay. Yeah, so the MPR is the monetary policy rate, which is this thing we're talking about. This one that they call policy rate is the monetary policy rate. So CBN comes up with that on a regular basis. And what you also need to note is that this monetary policy rate is linked to what the banks also give as interest rates for people who deal with banks. When they tell you, when you are looking for good deals with one bank or the other, and one bank will say, oh boy, the interest I can give you is only 24%. And you say, why? Now you say, oh boy, MPR is 19%. So our spread, that's our money from the bank, is only 24 minus 19. Because that money they are getting, 19%, they will go and give CBN. So it's only that difference between 24 and 19 that they can take as their money. That's where they make their profits. That's their P&L. So currently the MPR is, I think, 18.75 or something. They haven't had a meeting. So CBN has a meeting normally. There's a team, Monetary Policy Committee, I think, MPC. So that team sits together and determines the monetary policy direction. So I'm trying to bring what we are discussing home to Nigeria. They sit together and they say, okay, this is what we want the monetary policy to be. This is what we want the interest rate to be. And they use that to tackle inflation. Remember, like I said, they use it to tackle money supply, they use it to tackle inflation. So once the rate goes up, I think it was about 15, 14 at some point. So taking it up to 18.75 is because CBN is trying to fight inflation. They are trying to reduce the inflation rate in Nigeria. That's why they are increasing the policy rates. Since the new CBN governor came, I don't think they've met. So they haven't gotten a new rate. So it is still 18.75 or something. So what does that mean? It means that, taking it back to this our explanation, once you take that policy rate up, it means you are reducing the money that goes to commercial banks. Therefore, you are reducing the money that goes to individuals. Therefore, you are reducing the money that is in supply. Therefore, you are reducing inflation. This link, I will advise you write it down somewhere so that you know what it is. It is very important. The exam will not link it like this. The exam will go from point A straight to point F. You are the one that has to sit down and break it down into A, B, C, D, E, F, which is very important. So you don't waste time in the question. All right. So the things we'll now look at. Any questions so far? Okay. So the things we want to look at. So examine the transmission, blah, 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 blah. So let's look at, so the example we're using is a change in contractionary monetary policy. So we can examine the transmission mechanism in more detail by considering the effects of a change in contractionary monetary policy implemented through an increase in policy rates. So what does this mean? Can someone explain what this means? What does contractionary monetary policy mean first? Okay, how does that link to inflation?
Interest rates. Is the interest rate
Because some people will charge more.
I can't hear you guys. Oh.
So at the point when the government tries to mop money from the economy, that's contractionary monetary policy. By that, it would control or reduce inflation.
Okay. So that's that. So now this question is saying they implemented a contractionary monetary policy through increase in policy rates. That's what this statement is saying. That okay, let's assume we are in an expansion, for example, but let's assume inflation is high. Inflation is high in the economy, and the government says, "Oh, I want to bring down inflation," and they say, "You, Bolaji, CBN governor, what do you think?" And you come up and say, "I want us to increase policy rate from 5% to 10%. All well and good. That now takes you to a contractionary money because you have contracted the economy from the expansion where it was. So how does that affect lending rates? So it says banks' short-term lending rates will increase in line with the increase in the policy rate. I just explained this in that example. The reason, if you want to go and collect money from the bank now, the rate is high. Even as a company, the rate is high. They will just be begging you that, okay, even if you go to the other bank, it's the same thing. Why? Because this policy rate is a base for them. So when CBN is trying to control things, they give them this policy rate as a base. So currently, like I said, it's 18.75. So nobody will give you any loan lower than 18.75 as a bank. Because if they give you 17, that 1.5 difference, who is going to look for it? So they will give you higher than 18.75. How high it is now depends on the bank and how aggressive they are to get markets. Some banks will say 5% on top. So automatically you see them putting MPR plus X%, MPR plus 10%, MPR plus 5%. So whenever MPR changes, just add 5% to it. That's our money. Our own money is 5%. Nobody's arguing with us. But things change daily. So if MPR goes up, overall money will go up, even though our money remains fixed. Okay? So it says the lending rate will increase, which I've explained to you. The higher rates will decrease aggregate demand as consumers reduce credit purchases and businesses cut back on investments in new projects. What does that mean? Remember, this stuff is trying to contract the economy. So the moment there is no money in circulation, people that were willing to come to the banks to ask for money to buy equipment, they will not come again because the rate is too high. The rate is now higher than their return on investment. So when you get to some courses and you are trying to evaluate a project, MPV, these are some of the things you look at. So as a business, if I'm going to make 20% on an investment and I go to the bank and bank say they will charge me 25%, it doesn't make sense. So I'll be paying 25% interest while I'm getting 20%. Why now? Am I working for you? So what that means is that businesses will cut down on their investments. Consumers will also cut down all the credit purchases they are making. In fact, all the general purchases, they will cut down because there is no money. Okay? That's for that. The second one is bond prices, assets, and equity prices will decrease as the discount rates applied to future expected cash flows are increased. This is what I just spoke about. So when you get to the courses where you are doing MPV and the rest, you have what you call a discount factor. Right? That discount factor, whenever it goes up, your MPV comes down. That's what this is saying. So your bond prices, equity prices, everything that is being discounted to present cash flow will reduce. Okay, that's point 2. Point 3, both consumer and business businesses may decrease their expenditure. We've explained this one. Then, fourthly, increase in interest rates may attract foreign investment in debt securities, leading to an appreciation of the domestic currency relative to foreign currencies. An appreciation of the domestic currency increases the foreign currency prices of exports and can reduce demand for countries' export goods. Don't worry about this one. We'll still talk about exchange rate in more detail. Okay? So is that clear? Is that clear? So overall, demand will reduce, aggregate demand will reduce, and inflation will reduce because of one policy that CBN has done. So you see how we have linked it. Any questions? Do you guys understand?
Yes, for this last point, just like you said that you explain it later. But I'm just trying to link how increasing interest will attract foreign investment. Can you throw more light on that?
Sorry, I didn't get that.
I said I'm trying to wrap my head around how increasing interest rates will attract foreign investment.
Oh, okay. So when you look at bond, so for bond, there is the value of the bond and there is the interest on the bond. So when you see interest going up like this, the interest on those bonds are also going up, meaning it makes the bond more attractive. So people start saying, oh, this debt is giving me 5%. It was giving me 5% before. It is now giving me 10%. Therefore, people start bringing their money to invest in those debts or bond because the interest rates on them are going up. So the idea is that foreign investors would see that as attractive and then bring their money to the economy. And as they are bringing their money to the economy, your currency is appreciating, basically, because now money is coming in compared to when money is going out. But we'll talk a lot about that when we get to currency. Okay, Tayo.
Okay, I thought Bolaji raised his hand earlier.
Yes, I will get to him. Okay, you are okay.
Yeah, no, I just wanted to check my understanding on these lending rates, policy rate increment. Is it because I remember during Emefiele time? Please correct me if I'm wrong, but I think during Emefiele time, when they were trying to reduce inflation as well, they increased this rate. I think they did.
When they were what?
When they were trying to reduce inflation rates, I think they increased policy rate.
Exactly. They increased the rate, yes.
But then, reading this line, right, there's a line there that says the higher rates will decrease aggregate demand as consumer reduce credit purchases. That is where my own issue is. Do we really have credit system in Nigeria? And is this the reason why that increase in policy rate did not reduce inflation? That's just my question.
So yes, we have credit policy in Nigeria. Maybe accessible to only a few. And then maybe because of the interest rate, some people just run away from it. So this statement here takes effect, reduce demand. Reduce demand is that you don't have enough money to spend. So your demand will reduce. And then downward pressure on the price level. This downward pressure on the price level is reduction in inflation. Remember we said inflation is the persistent rise in general price of goods and services. So this downward pressure is that inflation will come down because of that increase in policy rates. So, like I said, in Nigeria, you cannot just put one and two together. There are a lot of factors related for Nigeria. So yes, they try to increase the monetary policy rates so that they can achieve reduction in inflation. But if you remember, like I said, it doesn't work that way because there are other factors, sadly. So even when you try to do one part, the other factors have to align for it to work and make sense. So to answer your second question, no, it wasn't because of the credit system. That's not why the inflation hasn't come down. If you really want to look at why inflation hasn't come down, we have to look at our exchange rates, the effect of exchange rate, the fact that we import a lot and we don't export, and we don't have foreign currency to back it up, and the fuel subsidy. The removal of fuel subsidy has led to a significant increase in transport costs. Transport costs automatically was rising before you say you remove subsidy. So the moment that went up, that just hit everything haywire. So whatever CBN is doing, until they can control transport costs. Personally, for me, I feel until we have a real system in Nigeria, or even in Lagos especially, let's say Lagos, or a real system connecting different states, we will keep fighting this battle, which is almost like a losing battle. Because what does rail give you? If you look at countries that are overpopulated, sorry, Bolaji, I'll get to you in a bit. So if you look at countries that are overpopulated, they use rail system to transport things, both human being and cargo. There's a different rail for cargo, there's a different rail for human beings. Transporting things through a rail system saves you a lot more money than transporting those things through road. And then you are able to transport a lot more through a train system than through road. So once we try and fix that, then you start seeing the real prices of things. Because at the end of the day, we come here or you go online and you see inflation is 28.9% as at December. But if you ask yourself, there is something you bought in November that you bought again in December. Is it only 28% it went up? Or something you bought January this year and you are buying it again in December? If you calculate the percentage change, I'm sure some things are entering 200%. Some things are entering 300%. That's far more than 28%. Because there's a transport element in it. So those are the dynamics of Nigeria. If we talk about Nigeria, we will not live here today. Bolaji, over to you.
Yeah, so my question is so I have I think 2 or 3 questions, but the first is, what is the relationship between the increase in the NPR and financial investments in financial instruments, fixed deposits, bonds, and all of that? Because I think when the government increases the NPR, you that means that the interest rate on things like fixed deposits should also increase.
Exactly.
If I'm correct. Yeah. So now this line says that businesses cut back on investments in new projects. Is that because they are now putting their money into financial instruments?
So it's a combination of factors. It's not just one factor. So one, yes, because first of all, there's no money in circulation. So the little money I have, I'm trying to spend it wisely. So I'm cutting down on investments. And remember, we said some of these investments, at the end of the day, you are going to use a discount factor. So for example, if an investment is supposed to give me 20%, and this new policy is 25%, I'm supposed to go to the bank to borrow money to go for this investment that will give me 20%. But bank is going to charge me 25%. So that does not make sense. I will collect money from bank at 25%, and I'll be getting only 20%. That does not make financial sense. So everybody starts saying, man, I need to keep my money for something better, or look for projects that will give me higher than the 25%. Then on the other hand, that the interest rate on the bonds and the debt starts going up. So it starts becoming attractive. So if you decide you want to put your money there as a company, fine. But you also have a situation where The foreign investors are looking at it and saying, no, this is attractive. I'm coming into this space. Or the business looks at it and says, this money I have in my account, I'm not investing it again because it doesn't make sense. And I'm not going to the bank to borrow money because it also doesn't make sense. So what can I do? Can I invest this little money I have in bonds, at least to get good interest rates? So that also works. But the main reason why they are cutting down on investment is because it doesn't make sense again. The investments are no longer viable. You don't have positive NPV on your investments. So you move on. Okay? Is that clear?
Yeah, that's good.
All right. Okay, so if there's no other question, I move. So remember that all this affects demand. So it's important you don't forget this. And demand is aggregate demand. If you remember when we spoke about demand and supply, there's individual demand, there's aggregate demand is the demand of everybody together. So what this does is that because there is no money in circulation, demand will automatically reduce. If you don't have money, you hide your face. You don't have money to spend. You just stay in your lane. You don't work anyhow. Because once you step out of your house, 5K has gone. So if there's no money, just stay in your house and you're sleeping. So that demand, that thing you would have bought, that is on your mind that you would have bought if there was money. Now you are not buying it. That's what we call decrease in aggregate demand. Okay? And of course, everything we are talking about has vice versa. So everything we have said on the contraction or the recession, it goes the other way. In terms of if this policy was reduced, lending rates will reduce as well. So you see, that's another relationship. Money supply and lending rates has a positive relationship. So these are things you need to write down so that you know. Money supply, inflation, and interest rates has a positive relationship. They go in the same direction. So it's important you know that. Okay? All right. So monetary policy relation with economic growth, inflation, interest, and exchange rate. So this one is now saying the effects of a more expansionary monetary policy may include CBN is buying securities, which increases bank reserves. So this one now, does it lead to expansion or contraction? This line alone.
It's contraction.
Any other answer? Any other answer? We move on.
Pass.
Okay. I can't hear you.
I said I think it's going the opposite direction. It's expansionary because CBN buying security means that giving more money to banks to be able to give to the citizens. So more money is being introduced into circulation.
God bless you. That's why I gave that example so that you understand the example. Don't let CFA confuse you. When CBN is buying securities, remember the example between Chuks and Bolaji. If Chuks is buying something from Bolaji, Chuks will pay Bolaji now. So once Chuks pays Bolaji, Bolaji has money to give to Temitayo. That's what this is saying. CBN will buy the security. That will lead to an increase in bank reserves. So it means that bank will have more money to be able to lend out. That's what this is saying, basically. Okay? So is that clear for everyone? Okay. The interbank lending rate will reduce as banks are more willing to lend each other reserves. So if this bank has money, the other bank has money, there's no need charging high interest now. Everybody want to lend out. So at least the money generates something with them. Then other short-term rates decrease as the increase in supply of loanable funds decreases the equilibrium rate for loans. there's a lot of money in the economy. So rates for loan will come down. Longer term interest rate also decrease. The decrease in real interest rates causes currency to depreciate in the foreign exchange markets. We'll get to that. Decrease in long-term rates increases business investment in plants and equipment. So of course, this is expansion. So you are thinking of the good things. Remember, businesses will want to invest. People will want to buy houses. Consumption will increase. Overall, demand will increase because there is money in circulation, which is the expansion. So this increase in demand increases inflation, increases employment, and increases real GDP. Okay? So question time. Number one, what's our answer? We need to be fast. We need to be fast. What's our answer for number one?
C.
Okay. Any other answer? So CFA, you get a lot of least likely and most likely. So the first one is out of it, Abi. So the question says CBN policy goals. Least likely includes. Least likely includes. Least likely includes. So number one is price stability. Is CBN here to stabilize price?
Yes, they stabilize price.
Hello, can you guys hear me?
Yes, they one of the goals is
Okay,
to
so
stabilize price.
somebody, only one person said C. The rest, what are we saying?
B. I'll go with
Yes,
B.
C is the correct answer. I think.
Anyone? So everybody in the class is saying C. Is that
I
it?
said B. Can you
Okay,
hear
so
me?
there's a B. There's a B, there's a C. There's a B, there's a C. Any contrary answer? So nobody is going to answer me now. C, why is it C? B, why is it B?
Okay, so my understanding of the question is the least likely reason or goals of CBN with regards to their policy. And I think price stability is one of the reasons for their policy and also maximizing sustainable growth rate of the economy. Minimizing long-term interest rates is not really clear enough. I mean, so I think that's actually my reason for going for this. I think that should be one of their least goals for the policies that they set up.
Okay. Our C. Why C?
I think that the one of the primary or typical function of the CBN is price stability, and then because CBN influences the short term interest rates, as part of the monetary policy tools, right? I think that will also extend to the long-term interest rate. So I will pick C because there are other factors in the economy that may contribute to the sustainable growth of the economy, politics. I mean, you also mentioned transportation and foreign exchange. So I think those things. I think the role of CBN in those things in sustainable growth is just like one out of many other things.
Okay,
Okay,
so
sorry. To also add to
you want to
my
change your answer?
no. I'm sticking to my view, but I want to support it with more points. So I also think that changes in interest rates is not really a goal for CBN. It's just a tool that they use to actually achieve a goal.
Okay, so we all know. So nobody is picking A. So then nothing to discuss about A. We are fine with that. So it's between B and C. So I need you to read the first word in that B. Oh yeah, I need everybody to read it. What's the first word? Read it out.
Minimizing.
Minimizing. We didn't say anything about CBN having the lowest long-term interest rates or trying to get the lowest long-term interest rates. We said it is minimizing. This example, this one is asking you minimizing. So it's saying he wants you to get the lowest interest rates. But we never said that. What we said is that it will try and balance the interest rates. Or is not, we didn't say it's going to arrive at the minimum, that it will try and get the minimum. No. As he's giving his policy, interest rates will be going up and coming down, going up and coming down. So there will be movement in interest rates. So that is that. So for C, he says maximizing the sustainable growth rate of the economy. So if you remember, we said in our last class, so maybe Bolaji, I can pity you because you were not in the first class. So we said there is real GDP, there is maximum employment, and real GDP. And we said real GDP is a state where everybody who needs to be employed is employed. Everybody who wants a job gets a job. We said that is real GDP. And we said that is linked to the growth rate of the economy. So what am I trying to say? This maximizing sustainable growth rate of the economy is the same as saying increase in real GDP, which if we walk back is saying increase in employment. And if we walk back, increase in employment can be derived as either an expansionary. If you bring up an expansionary policy, you can increase employment. Yeah, so the answer is B. But the main reason why it is B is that minimizing. So this is why I said solving questions is very important in CFA. In fact, it's more important than the notes because you need to understand how CFA thinks so that you start thinking that way in answering your questions. Okay. Because of time. Yes, number 5. Number 5 and number 6.
Yeah, class.
Oh yeah, answer number 5. Then Biodun will answer number 6. If Biodun's network is going. Can anybody help?
Okay, let me try.
I think number 5 will be C.
Who is that? Bolaji. Okay.
Yeah.
Onye,
Yes, I'm going with the C.
you are going with what?
I'm going with the C because when monetary authorities, which is the CBN, when they purchase security, that means they're introducing more money to circulation and obviously to reduce the lending rate.
So I didn't get that last. So after when they increase money in circulation, okay, what else? How does it link to your answer in B?
I said it will reduce, it's supposed to reduce the lending rate, but here the question said that it will increase. So, and remember, we are picking the list. What you should have done, in my opinion, is to reduce the lending rate and not increase. That's what I think.
They should what?
Can you hear me?
Yes, I can hear you, but I didn't hear what you said before.
Okay, so I said, in my opinion, what that activity should have done is to reduce the lending rate because there is more money to be made available to people that will need to get money from the bank. So, but now the option is saying that it will increase the lending rate. That's why I picked it.
Okay.
Yeah, what I
Bolaji,
think.
defend your answer.
Yeah, so I'm picking C. So because in the former question you asked, it talked about how the banks will increase their reserve. So when the monetary authorities purchases securities, they pay the banks, right? Then the banks have more reserves, and then that also says that they have cash in the investors' accounts, right? So these two are more likely to happen than the interbank lending rate. So that's why I'm picking the interbank lending rates, because I mean all the banks have rates, right? They have cash or they have money to play with. So it's the interbank lending rate will rather reduce than it's increasing.
Okay. Any country? Anybody has anything to say?
I think I will go with Bolaji. Yeah, because I don't see any reason why open markets will lead to increase in interbank lending rates. Definitely, yeah, that's why.
Yeah. Yeah, I read the answer now. Definitely return to I didn't see that one. Okay. Any other comments? Biodun, can you hear me? Can you unmute and just say something? Just say hi. Don't answer the question. Just say hi. Let me know you can hear me. Okay. All right. So we break the question down, which is what you should actually do in an exam situation. Purchase of security in the open market by monetary authorities. What does it mean? You people have answered that one. You got that one. Purchasing of security means that CBN will give commercial banks more money. So there will be a lot of money in circulation. Okay? Tick. Now, what does a lot of money in circulation mean to these three options? Yeah, that's what you should now be asking yourself. So when there's a lot of money in circulation, there will be excess reserves. So A is out of it because this question says least likely. Least likely. So it's most likely that excess reserves will go up. So this is off. B and C. I will take C. So C is increase in interbank lending rate. So if you remember, we said if there's a lot of money in circulation, interbank, if there is a lot of money in circulation, all the banks have money. So they will find a way, if they are going to give themselves money, if they are going to lend to themselves, they will lend to themselves at as low as possible because there's a lot of money. So if one bank is not willing to lend, you can easily move to another bank because there's money. When there's no scarcity of money, it's just like products. If there's no scarcity of the product, you are not arguing with anybody. Once you leave the first place, you go to the next place. You have options. So it's the same way this works. So where there's a lot of money in circulation, interbank lending rates come down because banks are willing to lend to themselves. So their willingness to lend increases. Okay, that's number 5. Number 6.
Sorry, please, what's the answer? Hello,
I
please.
didn't get that.
What's the answer?
The answer is C. I just explained it. Did you understand my explanation?
You know, the way you are driving us around the whole of Lagos, I thought it would not be you. Okay.
Yes, I need you to be very certain of your answer. Okay, what's number 6? Okay, because of time, the increase in policy rates will most likely lead to, this one is easy, most likely. Increase in policy rates means that, is there more money or less money in circulation?
Less money.
Less money, God bless you. So if there's less money, A, people will not invest. So A is out of it. B, people will not spend. So B is out of it. So if you want to use elimination method, the answer is C. If you want to understand it, is that because you increase the policy rate, long-term interest rates will also increase. And because long-term interest rate increases, interest on debt will go up. So meaning foreign investors will see your economy as attractive to put their money because they will get higher returns. That's that. Okay. So finally, monetary policy, they just look at the qualities CBN should have. We call it ICT, if you want to remember it easily. Independence, credibility, and transparency. I don't need to explain that. Then we have what we call targeting. So you have what we call inflation targeting, exchange rate targeting, which is that the government says, I want to target, as the word says, we are on 18.7%, sorry, we are on 28% inflation. Government can say, I want inflation to be 20%. So the question is, how do we get to 20%? Everybody starts going up and down to debate, blah, blah, blah. So that's targeting. You have interest rate targeting, you have exchange rate targeting. The other thing about targeting is you can say you want to target based on another country. Okay, I want to match what US is doing. I want to do this. So that's basically what targeting is. Now, limitations to monetary policy. I'll just run through this. Please mute if you are not talking to me. Okay. So bond market participants. So what this means is, so you have people you call bond market. Hello?
Please, can you take that last part? I'm not sure I got the explanation.
Which last part? The
Yes.
targeting.
Yes.
Eh?
Yes.
Okay. So I said you have situations in where a government or a country says, I want to do inflation targeting. So what it means is, for example, they can say, I want to match US inflation. So somebody can come now and say, I want Nigerian inflation to match US inflation. So we have set a target. Our target is US inflation. So if US inflation goes down, our own must go down. If it goes up, our own should go up, that kind of thing. So I've set a target. In some other cases, they set it as just a figure. It's not target, it's not based on a country. We just say, okay, we want our inflation to be 21% next year. That's a target. Just the same way they kind of used to do with the fuel price and all. irrespective of what's happening in the foreign market, they will say, I want to target so price as for price. So that's the target. So for you to meet that target, of course, you need to do some things behind the scene as CBN. You need to spend some money, just like the subsidy that we're doing, that they just removed. That subsidy that we're doing is as a result of targeting to say, okay, this is the price we want to target to sell this product, basically. Okay. All right. So for bond market vigilantes, so there are reasons why monetary policy will not work. That's what this is. Limitations of monetary policy. So what are the reasons why monetary policy will not work? One of them is bond market vigilantes. You don't need to stress yourself. What you need to know is that these people will just act in a different way from how they are supposed to act. That's all. So when they see money supply increase, that is supposed to make bonds attractive, they will do the opposite. So basically, vigilantes, they are just doing the opposite of what they are supposed to do. That's what this is. I don't want to bore you with the specific details first. We won't really need it in the exam. Another one is liquidity trap. Liquidity trap is that people have decided that they want to hold their money, irrespective of what you do. You can say, okay, you put up a policy where you collect people's money or this thing, but people have decided that this money, they spend that. I'm not spending this money. I'm willing to hold more money. You think you've made investment attractive, but no, I'm not going to invest. I'm going to spend this money. That's what this is, liquidity trap. Okay. Then quantitative easing. Quantitative easing is so for this reason, they decreased their lending even as money supplies were increased and short-term rates fell. With short-term rates near zero, economic growth still poor, and threat of deflation, central bank began a policy termed quantitative easing. So this is to reduce interest rates, to encourage borrowing, and to generate excess reserves in the banking system to encourage lending. So this quantitative easing came as a result of the bubble in the past, blah, blah, blah. So banks say, oh boy, I'm not spending what CBN wants me to spend. I will hold money. I will not give out loans. I will hold more money than I should hold, irrespective of what CBN's policy is. So that's what that is as well. Okay. So finally, remember I mentioned how monetary policy and fiscal policy should work together in an economy, and why we are facing one of those challenges in Nigeria. So the first one here is 1 minute, please. All right. So the first one is expansionary fiscal and monetary policy. What does it mean? It means that from the fiscal side, it's expansionary. For the monetary side, it's expansionary. So please, can you tell me, is it budget surplus or deficit for expansionary fiscal policy?
Budget deficit.
Please repeat the
Budget
question.
deficit is expansionary.
Fantastic.
Yep. Because that
Thank you.
government spending increases.
Exactly. Thank you, guys. So budget deficit, of course, means that expenditure is higher than revenue, meaning that there's more money in the economy. So that's for expansionary. Now, expansionary monetary policy. So somebody should give me an example of this using any of the any of the things we have mentioned. So somebody should tell me if I increase this one or I reduce this one, it will lead to expansionary monetary policy.
When you reduce the policy rate,
What?
when the government reduces the policy rate, that's expansionary, but that will introduce more money.
Exactly. So reducing the policy rates leads to expansionary monetary policy. Thank you very much. So the first policy is that fiscal. So you see that, is this a direct or an, is this a positive or a negative relationship? So this is a positive relationship because fiscal policy and monetary policy are going in the same direction. So let's now note the things that are happening here. So there are some key things you need to note. Interest, GDP, which is also called real output or aggregate demand. Please be noting these things I'm telling you. Interest, GDP, output, which is also GDP, inflation, then yeah, basically these ones. So you need to know how expansionary or contractionary things affects them. So for this one, that fiscal and monetary policy are both expansionary, you have a situation where interest rates will be lower because of the monetary policy, and then the private and public sector will expand. So another thing I want you to note is that interest and inflation are linked to monetary policy. They follow monetary policy. While GDP and public sector, or let's say output, just say public sector and output follows fiscal policy. Okay, so the next one is contractionary fiscal and monetary policy, which is the opposite of what we have just said. Now, number 3 is expansionary fiscal policy and contractionary monetary policy. What does that mean? It means that one is going forward, one is going back. So what will happen to the economy in this situation is aggregate demand will be higher because of fiscal policy. Remember I said aggregate demand or GDP or output is linked to output, basically, is linked to fiscal policy. So aggregate demand will follow fiscal policy. Interest rates will follow monetary policy. So you see interest rate is high because monetary policy is tight. Then the other thing they should have added, public sector will improve and private sector will decrease, because public sector will go with fiscal policy, private sector will go with monetary policy. Then also you have the last one, which is contractionary fiscal and expansionary monetary policy. So what does this mean in this case? It means that you have your fiscal policy is contractionary, is soaking money out of the economy from a fiscal policy. But your expansionary policy is putting in money in the economy. So how do you balance that? So of course, interest rate will follow monetary policy. So as interest rate is going down, sorry, as monetary policy is going up, interest rate is coming down. Inflation will follow monetary policy. So as monetary policy is going up, inflation will go up. And then private consumption will go up because of money supply. Because fiscal policy is negative or contractionary, the output will reduce because of the fiscal policy. Okay, so at the end of the day, you see that it makes sense that the two of them go together. That's what I said. That if these two policies don't go together, you'll be having conflicting situations. That's basically what it is. Two things that will be conflicting. Okay? Any questions? Any question? Okay. So this is the table that we just spoke about. So monetary fiscal. So you see that there are, how many did I give you? Okay, there's interest rates, there's outputs, there's private sector and public sector. So when they are both tight, so if you notice, interest rate is going with monetary policy. So when monetary policy is tight, interest rates will be high. When monetary policy is easy, interest rates will be low. It's clear. Output is going with fiscal policy. When fiscal policy is tight, output is low. When fiscal policy is easy, output is high. But in a situation where fiscal policy is tight, output is supposed to be low, but because there is increased monetary policy, it means that it may vary. So what this varies means is that it depends on which one is stronger. The effect of the fiscal policy, is it stronger than the effect of the monetary policy? That's what this one is saying. Okay. Then private sector spending goes in line with monetary policy and public sector. Like that, like that. Any questions? So no question for me. All right. So I move to geopolitics. So geopolitics was introduced to the syllabus. That should be last year. Yeah. And it's basically very simple. There's nothing technical there. It's just telling you what you already know in a lot of English. That's basically what it is. So it's a very short reading for you. Okay, so I move. So geopolitics refers to interactions among nations, including actions of state actors and non-state actors. So what it's saying basically is, how are countries interacting? So remember, I told you guys when we started that we are taking this economics. There's a flow to the economics. We started with you as an individual. What do you demand? What do you want? How do you react to prices when prices change for what you want? We move from there. Then we move to, okay, let's look at the companies that produce these products that you want to consume. Then we looked at the cycles to say, okay, what are the different cycles this company is faced with? Then we move to overall output, which is the overall aggregate output of the country, real GDP and all. And we said, okay, this real GDP, how can we, real GDP and inflation, how can we change it? What are the things that are within our control, which is what we just explained. Now we're now going to countries, interaction between countries. We have looked at, you see, from individuals to firms to country. Now we are going to countries. So the question is, as a country, do you want to stand alone? Do you want to do your things alone? Do you want to interact with other countries? We'll talk about that in international trade. How do you interact with other countries? And then we now said, let's look at the politics of this. Because it's not just saying two individuals interacting and two countries interacting are not the same. So two countries interacting, there are a lot of things they need to factor. Okay? So geopolitics now says, okay, there are interactions that happens between governments where you have, that's what they call state actors. When you have one government talking to another government, then there are interactions with non-state actors, which are companies, no NGOs and individuals. When you see Dangote, for example, going to other countries to discuss business, is a non-state actor. When you see Mark Zuckerberg coming to Nigeria to discuss things, is a non-state actor. So those people too also have to deal with the geopolitics of things. So this is politics plus geography. That's what we call geopolitics. The geography is that the interaction between different countries. Then the politics is the politics you already know. So in this case, we're looking at, so there are two things. There is cooperation and competition. Cooperation and competition. So this geopolitics is saying, okay, what is the extent to which countries cooperate in terms of military matters, diplomatic matters, culture, rescue. If, for example, something happens, they are fighting somewhere, what is the rescue plan? Those are what we call cooperation. Freedom of movement, in and out, we'll talk about that in international trade as well. How do we trade? What are the rules of engagement between our countries? That's cooperation. Then you get to cooperative. So cooperation, you can decide to cooperate and not cooperate. So if we don't agree on some matters, then we may be considered as not cooperating. So as far as you are still, your policies or your direction is still in line with what I want, we are cooperating. The moment is no longer in line, cooperation has ended. That's basically what this is saying. The moment we are no longer together, cooperation has ended. So the Russia-Ukraine, this thing, we know what has been happening there as well. Okay? So we can analyze the country's national interest as a hierarchy, with its top priorities being those to ensure its survival. So every government wants to ensure, every normal government wants to ensure that the citizens are safe and they can survive, which is basically safety. And then you move to material things, which is now food, clothing, and housing. So that's basically what that. So a country that has a natural resource knows that already people want to come to it. There will be a lot of people that want to cooperate with the country. That's basically what that is. Now we start breaking it down. Then you have the non-state actors. So non-state actors, we mentioned individuals, firms. So those ones just want to be able to put their resources in a place and generate interest on their resource. That's all. Make profit on their money. That's what they are in for. So at the end of the day, there's what we call standardization, which is, let me just go to the table. I think there's a table. We have a table. Okay, yes. Okay, I'll get back to this. Let me just continue. So standardization is a situation where if we are going to be doing business consistently and resources are going to be flowing, we need to ensure that we have things that are common to us. That's the standardization. An example is IFRS. So as a country, so you have people who are coming to invest in Nigeria as foreign investors. There needs to be a way for them to, one, take their money out of the country, two, to be able to monitor their investments. So that standardization has to be there. That, okay, these two countries do this, these three countries do this. So even if I go to another country that has a similar, that we have similar cooperation with, I should be able to get the same kind of standards. That's what this is saying, basically. Okay? Now, globalization. So globalization is basically worldwide integration. So when we talk about things like CO2 emission, we talk about going green, we talk about energy, what's that popular thing that they're always talking about? Okay, when we talk about things that the world is trying to align on, the world is trying to align on similar goals. That's what we call globalization. All of us come together and align on one thing. Yes, ozone layer, discussions on ozone layer and all. How can we all as a country come together and align on one thing? Those are the things that globalization is. Then you have nationalization. So this nationalization is you as a country, you are pursuing your own interests. You are pursuing your own interests. It's not about global interest. It's about your interest. So that's nationalization. Okay. So this is basically the chart you need, which is the balance between cooperation and globalization. So you have 4 characters. So I start with the first one, autarky. So autarky is you are just doing your own thing. So this one we can almost say is like Russia trying to stay on their own. Trying to do their own China, or sorry, North Korea. Yes, North Korea is the example I was looking for. You are trying to do your own things. You are not, you want to be separate from other countries. So autarky is you are not cooperating and you are not even doing globalization. You are doing your own non-cooperation and your own nationalism. So this refers to a goal of national self-reliance, including producing most or all of your necessary goods and services domestically. It's often associated with a state-dominated society in general, with attributes such as government control of industry and media. So this is basically North Korea. As it is, I don't know if there's anybody here that knows what's happening in North Korea that can come and tell us. It is a closed, I think it's getting a bit relaxed now, maybe just a bit, but it's a closed space. Information hardly goes out. And they are living, people are living there, they are not dying. But they are not dead, let's put it that way. So it means they are trying to self-sustain themselves. Okay, then you get to hegemony. So this is non-cooperation but globalization. So what this one means is that you are not cooperating with anybody, but you are almost going in line with their goals. Okay, they are doing CO2 reduction in CO2 emission. You are also doing your own. So you are big enough. You are open to globalization, but you are not cooperating. Then you have bilateralism. This one is you are cooperating, but you are still doing your own things. That's why it's called bi. So in some cases, you may need to draw a line that, okay, yes, I'm cooperating with you, but this particular thing that you want to do does not go in line with our own. For example, Nigeria, when they were trying to, Nigeria and the LGBTQ stuff versus Nigeria. So in the US, they are free to do some of those stuffs. But in Nigeria, there are laws against some of those things. So yes, Nigeria and US, they cooperate in things, but for this particular point, Nigeria will stick to its nationalism and not move towards globalization. That's what it is. That's why it's called bi too. Then you have the multilateralism. This one is clear. You are cooperating and you are global. Then you have the regionalism. These are basic English. You just, once you hear the English, you know what it is they are talking about. Okay. So then you also have non-state actors. So you hear things like FDI. FDI is foreign direct investment. So it's when one company establishes a factory or something in another location. So you cannot say you are doing FDI when you are doing small. Just that when people say they are multinational. Some companies are not really multinational. If you check the definition of multinational, just call multinational anyhow. Okay. So the next one is IMF. To talk about IMF and World Trade Organization, I'm not going to waste time here. It's just something you should go and read. So IMF main goal is international monetary cooperation, facilitate expansion and growth of international trade, promote exchange stability, and assist in the establishment of multilateral systems. Then we go to the World Bank. So World Bank says their mission is to fight poverty with passion and professionalism for lasting results. Then you have the World Trade Organization. So this one sets global rules for trade between countries to ensure that things are flowing smoothly. Okay. Then you have the geopolitical risk. So for geopolitical risks, you have event risk, which refers to the event about which we know the timing but not the outcome, such as national elections. Today now there are some elections happening in some parts of Nigeria and Lagos as well, by elections. We know that's what's going to happen, but we don't know what the election will lead to. So that's the event risk. Even when we had election last year too, people were skeptical. Election is happening. Oh. Be careful where you go to. Be security conscious. We know the events, but we don't know the outcome. So that's the event risk. So you see, it's geopolitical risk. So things that can affect international relations. You know, at some point when we're doing our elections, foreign countries got involved. Before the president was officially announced, some countries had already started saying, okay, this person, that person, this person, that person. So that relationship is there. Then you have exogenous risk, which are unanticipated events. So you cannot run away from it. War, flooding, outbreak, you cannot run away from this one. You cannot anticipate them and they come. Then you have thematic risk. So this is migration. Known factors that have effects over a long period. So when people are migrating from one location, see people now, if I ask how many people here are planning Japan, I know how many people will raise their hands. So that's the migration. You that Nigeria is having plans for, you are having plans for Canada or US or UK. UK at the moment is not having plan for you. Then you will not come and enter the economy. So it's like that. So that's why you see sometimes some countries try to restrict the number of people that come to their country to say, okay, I will only admit 200,000 people. Then they can plan for that 200,000 people to reduce this thematic risk. It's okay, my relationship with this country will not be affected by this. Yeah, so that's basically that. So to analyze velocity of geopolitical risk, we can classify risk as high velocity, which is short term, medium, and low velocity. So velocity, if it has high velocity, it means it's intense and it's coming in a short period. Low velocity, long term. Okay. Then tools of geopolitics and the impacts. So you have national security tools. Remember we said there are state actors and non-state actors. So national security tools, of course, in terms of war and all those things. So if a country is threatened, Ukraine-Russia war, they are using, one of them is using their national security. They are both using their national security tools. Then you have economic tools. Economic tools in terms of the kind of union you are in. What does that mean? Are we in? We'll talk about that in international trade. Is it so? You hear EU economic union. What does it mean? Those kind of things. That's economic tool. Then you have financial tools, which are exchange rates and all. Then you have sanctions. So you see, one US will sanction one country, or they will come together and say, "Oh, this country has gone against our policy, our agreed policy as a team. Therefore, we put this sanction on you." That kind of thing. Okay. So impact of geopolitics. So basically, the idea is to try and manage this risk. It's a risk. So what do you do as an investor? You try your best to ensure that you are covered. So you try to do scenario analysis to get the political effects of things, blah, blah, blah. To see signals. Okay, this is happening. This is likely to lead to this. That kind of thing. Okay. Any questions? So let's go to number one. Can we answer number one? Sorry, I didn't get that. Can you please speak up?
Yeah.
See.
All right. So C is right. You are working together. You are working together. So, however, there is a nationalism effect there. So that brings the buy. So once you see buy, you know that there are two things that are different directions. Okay, number two. Okay, so number two is what is non-cooperative economic tool? So you need to ask yourself which one is the economic tool there. So for the voluntary export restraint is to say, okay, I'll be exporting less to another country. So let's say everybody wants to export 50,000. I said, no, the limit is we can only export 10,000. So that's A, basically. That's the answer. The answer is A. B, regional free trade agreement. This one is not non-cooperative. You say it's free now, so it's cooperative. Free trade. Free trade means you cooperate with yourself. Then C, restriction on conversion of currencies. This one is not an economic tool. So that's why you have to be careful with CFA. It is not an economic tool. It is a financial tool because it looks at currencies. Very, very important to pay attention. Number three, what's our answer?
Yeah, sorry. So which is the answer for number two?
Number two is A. Can I continue? All right.
Yes.
So number three, what's our answer for number three? Okay, so the answer is B, thematic risk. Because if you remember, we said thematic risks are risks that last over a long time. Like human, people relocating, that kind of thing. Event risk is a risk, but most times event risk has a short-term impact. Where we spoke about velocity, high velocity and low velocity. So the impact may be huge now, but it's only short-term. Then you have exogenous risk as well. So the same way, it's also high, but it's just for now. So as an investor, if you want to invest for a long time, these ones that are now short term, they will come, they will go, they will come, they will go, but the market will stabilize. But you have to look at the long-term risk, basically. Then number four, the answer is World Bank. they are concerned with providing assistance to developed country because of time. The WTO, like we said, is for trade, promoting trade and settling disputes. The IMF, we know, is for trade and exchange rates stability as well. But for economic assistance is World Bank. Any questions? All right, thank you. So we go to our last reading for today before I release you. All right. So we've spoken about, this one will be fast because we've spoken about some of these things before. It's just to go into the specifics. So what is international trade? Trading between two countries. Basically that, we know that already. Now, why are you trading between countries? Why are you not staying alone? So the reason you are trading is because, one, you may not be able to provide everything that you need within your country. So what do? You have to find a way to balance it, especially if you want to have interactions with other countries. You have to find a way to balance what it is that you are producing and what it is that you need. So what does that mean? That takes us to what we call comparative advantage. I'm sure you guys have heard of it before. So every country in the world cannot be producing rice because rice is good or easy to produce, for example. Or else the whole world will not survive. Everybody, imagine all the countries are producing rice in the world, then we have a serious problem. So what happens is that every country has to see, okay, where do I have comparative advantage in producing this product over another country? Then you focus on that. Okay, so this is international trade. Remember, this is assuming the bilateral or multilateral system. We're assuming that you want to cooperate. Remember, we spoke about cooperation and non-cooperation. Here we are assuming you want to cooperate. And so you want to cooperate. Okay, how far can we cooperate? How easy can we cooperate? And how deep is our cooperation? So that's basically what this is saying. Nothing special there. Okay, so you now see things like free trade. So you are putting free trade because you want it to be that it's easy. It's easy to trade within yourselves. There are no restrictions between my country and your country. That's basically what this is saying. So of course, remember there is import and export. So when we get to exchange rates, we'll talk about that as well. Once you are selling to another country, you are exporting. Once you are bringing in stuff, you are importing. Okay, so another thing to factor is labor costs. So for those of you that are familiar with Apple and Samsung and all those things, you will know that majority of the phones that we use are produced in China because they can get cheaper labor there compared to the country where the multinational exists. So it's cheaper to produce there and then bring it to the place you want to sell it to. That's basically what that. So people look for where it's cheaper to produce and then import it to their country, basically. Okay. Then types of restrictions. So this one is very, very important. So why is there restriction in the first place? Why do countries say, oh, I want to restrict what I'm doing with this other country? One of them is infant industry. So you want to promote that industry. Let's say an industry that is just starting. You want to promote that industry. You don't want people to import everything and then that industry doesn't grow. So you say, okay, I want to either limit what I'm importing or I want to completely say no importation of this product. We will produce locally. We try to do that in Nigeria, but of course, before you decide to do this kind of thing, you need to ensure that you can meet the demand. If you cannot meet the demand, then you are wasting your time. you will just create an artificial scarcity and losses. You will see when we get to the explanation. Consumer loss, producer loss. People are losing money everywhere. Plus the person producing is losing money. Plus the person buying is losing money. And then the quality as well. People complain a lot of our rice, local rice versus foreign rice. That if you cook local rice, this stress is to take you to pick all the stones. You will just give up. Versus foreign rice, which they've gone through that pain and it's a lot better. So if you want to promote that the industry in Nigeria, you call it an infant industry, you need to ensure that that quality is met in Nigeria. That's what this is. Then you have national security. Of course, there are some things that you cannot give out. Because if you give sensitive information to other countries, they'll basically use it against you and try to take over you. So those are the two reasons why people try to restrict some things. Okay, another thing is protecting domestic jobs. So they believe that if they restrict it locally, people will be more employed, you employ local people, that kind of thing. Then protecting domestic industries as well. So plus the job, plus the industry, that can be an argument. Okay, so what are the types of the restrictions? So we have said why, but what are the things you can actually use to restrict trade? So one is tariffs. So tariffs are taxes on imported goods collected by the government. So what does that mean? You can import these goods, but me, I will charge 20%. Me as per government. So if this good is 100 naira, I will charge you 20%, 120. So it's up to you. So already you know that if I import something 100 naira, I give government 20 naira. I'm not going to sell it 100 naira to you. That means I'm making a loss. So at the minimum, I will sell it at a 120 to at least not to lose money. So what has that done? That has now increased the cost price of the product. Then it starts making people think, do I really need this product? This product is too expensive. Oh, I don't need it again. Oh, yes, I need it. That kind of thing. That is what this is saying in terms of tariffs. Then you have quotas. So quota is saying, okay, yes, import, but this is the maximum quantity you can import into the country. So I've given you a quota, a limit. You cannot go above that limit. Then you have export subsidies. So government is saying, I will pay you to export these goods, which is almost what government should be doing now, because at the end of the day, government wants to generate foreign currency. You can only generate foreign currency when people export things and bring in foreign currency into the country. So that's also another strategy for government. The minimum domestic content. So for this one, for those who have worked for multinationals and the rest, there's a percentage of the local content in terms of local people, content in general that you must have. So you cannot come now and say you're a foreign company from Italy and all your staff, you bring all of them from Italy and bring them to Nigeria. No, and they are the only ones working. No single Nigerian working in your factory. Then you have a problem. You have not met minimum domestic content. So they will tell you this is the limit of the number of people you can bring. The rest will come from local guys. Then voluntary export restraints. So this one is similar to export subsidies, but it's now a case of volume. So this one, you are restricting the quantity of goods that you want to export. So this one most likely is because you know that maybe that country, they have set a tariff or a quota, basically, to say you cannot import more than this. So based on that, you try to reduce how much you will pay. So that's voluntary export restraints. So are we clear on the definition before we move into the applications? So now tariff, I kind of explained this. So a tariff is you place a tariff on a good. That means it increases the domestic price. So it increases, we have explained this. If a product is 100 naira and you put tariff on it, it becomes 120. So meaning those that are buying the product in the country will buy it at minimum of 120. Number two, it decreases the quantity imported. Of course, the moment tariff starts becoming high, people start saying, is this business really worth it again? Okay, I'm not doing again. I'm not doing again. That means the quantity that is coming into the country starts reducing. Then it increases the quantity supplied domestically. How? If you know that the imported quantity has reduced. So because, remember we spoke here that there is decrease in quantity imported. Demand has not changed. So let's use cigarettes, for example. Let's say the demand for cigarettes is 100,000. They've now put a tariff on it. So what that means is that 100,000 used to be imported, but now they are not importing 100,000 again. They are now importing what? 80,000. Meaning there's a gap of 20,000 because there are still people that want to smoke that cigarette, that want to buy the cigarette. So what happens to that 20,000? That 20,000 can be fixed by the domestic markets. So domestic producers have a chance to bring 20,000 into the economy. But what if they can only bring 15,000? So they bring 15,000 and then you have a 5,000 loss. So that loss is demand, money that could have been made that has not been made because of this policy by the government. Okay? Domestic producers gain. We know this one because they would sell at a price close to foreign products, and then they will sell more in terms of quantity because there is a gap. Foreign exporters lose because where are you exporting to? Domestic government gains by the amount of tariff revenue. So that revenue that extra 20 naira, government will take it. That's their revenue. Then we'll go to quota. Sorry?
There will be less importation.
Yes, there will be less importation. That's the overall.
So that's the government gains. They might not gain now because they might even gain less than what they were gaining before. Because importation has dropped.
Who will gain less?
The government, because importation will drop.
So we are looking at it. So the question is, importation in itself did not generate money for government. It's the tariff that generates money.
And that's what I'm saying. When the tariff is increased, there will be less tariff now.
No, we are looking at two situations. Scenario A, there is no tariff. The cigarette costs 100 naira. In that situation, government is not making any money. Scenario 2, government says, okay, I want to bring up a tariff of 20 naira. So that becomes 120. Government is making 20 naira per every cigarette. So even if the quantity imported reduces, previously, scenario 1, government was not making anything. But now they are making something. So 20 naira of whatever they have imported, government will make it, compared to scenario 1 where they were not making anything at all. Do you understand?
Good.
Is it clear?
Yeah.
All right, thank you. So that's for quota. That's for tariff. So quota restricts the quantity. So when you restrict the quantity, what does it mean? It's almost like tariff. It's the same direction. But this one is quantity you are restricting. You're not restricting price. So domestic producers will gain because, of course, there will be market to take. Domestic consumers lose from an increase in the domestic price. The right to export is very quantity is granted by, okay, all these ones are stories. So in the quota, there may be, so what they are saying here is that government may charge import license. That's the way they can make their money. But not in every case. Okay? So if you look at this graph now, you have, can you see the graph?
Let's see.
Can you guys see the graph, please?
Yes.
All right, thank you. So you have a price for the world, and then you have a price with protection. This protection is either tariff or quota. Then this world price is the normal price. So you see that the price with quota, which is called price protection, is price. Now you see this place is the money that government is making, the extra money, this blue line. Then you have a gain in producer surplus, which is those domestic producers that will gain from it. Now you now have a reduction in quantity. So quantity supplied and quantity demanded. So you see that at the normal price, quantity demanded was here. But now that price has gone up, quantity demanded has reduced. The normal law of demand now, guys. Increase in price, reduction in quantity demanded. So quantity demanded has come down because of this protection. Now, what happens to supply? You have a supply and you have domestic supply that is now increasing because of this protection, this thing, but it's not increasing enough to cover the gap. So in some cases, you have what you call consumer loss and producer loss. Okay, any questions? All right. Then you have voluntary export restraints. We've spoken about this one. This one is clear. You are the one restricting your exports. Then you have export subsidies. So this one will benefit the exporter. This one is clear now. If I'm an exporter of a product and government gives me subsidy on it, it benefits me at the end of the day. But the actual price of the item is higher. Okay. So at the end of the day, the summary is that most of the 4 protectionist policies are the same with respect to domestic country. So if you add quota, tariffs, blah, 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 one, they all reduce imports. So this is the summary of everything which you need to note. They all reduce imports. They all increase price. They all decrease consumer surplus. They all increase domestic quantity supplied. And they all increase producer surplus. So producers are making money, consumers are losing because prices are going up. So that is that. Then you have capital restrictions. This is just basically some countries saying that they want to restrict the flow of capital in their country. Okay, so explain motivations for and against for and the advantages of trading bloc, common markets, and economic unions. So we spoke about economic union before. So now we will now break it down. There are different levels of agreement between countries. So the first one is free trade. Free trade is that there's no barrier. All barriers to import and export are removed. So that's why you hear things like free trade zone. Once we are in that free trade, everything is free, no barrier. Then you get to custom union. So as we move higher, we start adding restrictions. So custom union now says, so we start expanding our relationship. Custom union now says, okay, let's adopt a common set of trade restrictions. So what does that mean? Let's say Nigeria, and then, okay. So let's say we have Nigeria and US. In the first one, free trade, Nigeria and US are free to trade with themselves. No issue. Keep on trading. But when you get to custom union, we now say, okay, it's not enough that Nigeria says it's not enough that me and you are trading. I want you to stop trading with Russia. So we are not a custom union. So okay, fine. Even though 2 of us are trading, we now get to the stage where we say, no, No more trading with. So all countries adopt a common set of trade restrictions with non-members. So anybody that's not a member, we all treat them the same way. Then you have common markets. So common market adds that barriers to movement of labor and capital are removed. So there are some countries that you have serious barrier to enter their country and say you want to work. There are some countries where you don't even need visa you don't need passport and visa to go to. You need passport, you don't need visa to go to. Then economic union. You have, so this one has now added member countries establish common institutions and economic policy for the union. So in addition to what we have been doing before, we now say, okay, we want to be an economic union. When you hear EU is economic union. We want to have a common policy. Then you have monetary policy. Monetary policy now adds that, okay, apart from having a common policy, I want us to adopt a single currency. We would all have only one currency together. So that's when you see countries adopting similar currencies, or they are all benchmarked to the same currency. Okay? So those are the levels to this. So of course, European Union is part of economic union and all. Eurozone is monetary union. So everybody knows that we're here with one currency. Okay? Any question? So let's answer number 2. Number 2, guys.
B.
Say that again. I'm hearing C, I'm hearing B. Is it B for baby or C for cats?
Baby.
I'm hearing AB now. Which one is AB again?
I think it's A.
What's our answer, guys? Okay, somebody thinks it's A. Okay. I'm listening, guys. Okay. So the question says an agreement with another country to limit the volume of goods and services sold to them is best described as what? To limit sold to them, not buying, sold to. Selling to means you are exporting. You are not importing, you are exporting. So the answer is voluntary export restraints. The quota is import, not export. I'm limiting what is coming in. It's not what is going out, it's what's coming in. I'm limiting what is coming in. Now you now get to minimum domestic content rule. That one, I don't need to explain that one. It wasn't part of what we discussed. In line with volume. All right, number 3. I need you to settle down and think about this carefully. Carefully.
B. For baby.
I'm listening now.
B.
B. Okay, why B, please?
Auto industry. They will use the steel now. They will use the steel. Domestic steel producers should be happy. They can really increase their prices. The workers there don't suffer any loss.
More demand, more implement in the economy.
So please explain how. I didn't get you clearly. Sorry.
I sure you get us this man. B for baby.
Is what? Okay, so the answer is B, like you said. So it will benefit the domestic steel producers, because like we have said, any tariff always increases price. And in increasing price, domestic producers will want to take advantage. So it will benefit them because there will be a volume reduction, volume gap that somebody has to fill. So it will benefit producers. It will benefit the workers too, because they will produce more, clearly. It will affect the workers in domestic auto industry because the price of steel will go up, and steel is being used in the auto industry. Basically that. Number 5. What was our answer?
Free trade. A.
Are we all going for A? Are we all going for A? So the answer is not A. Next.
Economic union.
So the question says, in which type of regional trade agreements are economic policies conducted independently by the member countries, while labor and capital are free to move among member countries? We have somebody that is ready to answer and tell us why. All right, so the answer is B, because it's common market. So the labor and capital movements are not free in free trade. You mentioned that. And then it is not economic union, because they've clearly stated that economic policies are conducted independently. So we have to be very, very careful when it comes to these questions. Okay? Any question for me for today?
Yes, sir.
Any question for me? Okay. I don't want to take the new reading today, so I will release you. If there are no questions for me, thank you guys and enjoy the rest of your week.
Bye.
Bye. Bye.